Good morning, I'm Leah Milner and welcome to ActivTrades News. Today I'm going to be joined by Samuel Ray, founder of Traffic Feed. Firstly, we're going to be discussing a week of poor economic data from Germany. We'll be asking whether this signals a global slowdown in growth and whether it's the result of weakening demand from China. Then we're going to look at the recent rally in the price of oil above $50 a barrel. We'll be asking whether it's the beginning of an upward trend or if prices need to stay low in order for the market to rebalance. Then we're going to be talking about the big topic at this year's IMF meeting in Peru, that's China. We'll be asking whether it's a country trapped in a vicious cycle of poor economic news leading to yet more policy blunders and panic. Finally, we'll be looking at why global stocks have been trading at an 8-week high. We'll be asking whether markets are pinning too much hope on central banks maintaining interest rates at record lows and keeping up with asset purchase schemes. So Samuel, welcome to ActivTrades News.
Thank you, Leah. Thanks for having me.
Let's start with Germany. What does this week's data show?
It shows that Germany could be in trouble with exports down, even with consumer demand and a little bit of import strength. It shows that what's happening in China is going to affect what's happening in Europe.
So do you think this is the signal of a global slowdown?
I think we've seen a number of signals already. I think it's the latest in a string of signals what's happened in the US with the interest rate non-hike and what is already happening in Europe with the potential for quantitative easing. I think it's almost a confirmation signal that what has happened could and probably will happen.
And do you think stronger domestic demand in Germany might help to offset some of the weaker export growth?
Near term, probably. I think as export weakens further, it's going to filter through to demand because industrial production will fall, consumer demand will fall, people will get laid off, and then domestic demand will follow exports. So
that's a bit of a vicious cycle.
Longer term, no. Near term, yes.
Okay. And what about demand from emerging markets? Do you think that it's sort of the situation for Germany is about sort of weakening demand beyond just China and also that of emerging markets as well?
Yes, I do. Germany relies heavily on emerging markets and especially China. It has done for the last 10 years, I believe. Over the last 10 years, the percentage of German exports has doubled from 3% to 6%. But to 2014, now it halved again, but just over the first 6 months of this year. So, yeah, it's really going to affect them.
Right. Okay. Now let's look at the oil price. It's up over $50 a barrel for the first time since July. Yes. What do you think's driving that?
I'll be honest. I think it's a media-driven rise. I think there has been lots of talk in the media recently about oversupply, and there's been lots of, especially with Iran and what's happening there with the nuclear deal, that drove the price down. The media has sort of switched around on that now and is saying the supply is tightening or could tighten over the next year or so. So I think it's speculative.
Right.
I don't think there's any sort of real fundamental driver behind it. There may be some geopolitical risk, I know we're going to talk about that, but I don't think it's, I think it's short term and I think it's speculative.
Okay. I mean, it's good news for investors, but it's pretty bad news for consumers, I imagine.
It's good news for investors if they're long oil. If they're short oil, it's bad news for investors.
Right.
For consumers, I think it takes, there's always a lag. It takes a while for these increases and decreases to price into what consumers end up paying. So if it stays above $50 a barrel, it will be bad news for consumers, but whether it will or not, we'll have to wait and see.
So you've alluded to this a bit already, but do you think it's increasing geopolitical risks that are being priced in?
Yeah, again, I think there will always be an overspill effect from geopolitical risk. I think we saw it with what happened with Russia, Georgia, Ukraine last year, the year before, when that flight went down, even that affected the price of oil just because they thought the through routes were going to close. So, I do think it is, but I'm not sure it's a sustainable way to judge or forecast the oil price based on geopolitical risk.
Right, okay. So do you think it's the start of an upward trend, or do you think prices are going to stay low in order for the market to kind of rebalance itself?
I mean, there has been talk for as I said, the whole year about an oversupply and US reserves of oil, and when you actually look at the oil figures, when you see the reserve figures, they fluctuate up and down as the year goes by. Normally through March, April, May, they're higher, and that was when we saw the media saying that we're at 97% reserves, 98% reserves, it's unsustainable, the price is going to fall. Now they're going down a bit, the reserve levels, and they'll be back up next year, and we'll be in the same position next year and saying the same thing. So, yeah, it could stay above $50 a barrel easily if the media can maintain its approach.
Right, great. So what about China? Do you think it's a bit of a bad news cycle that's sort of reinforcing the situation there?
Perhaps. I think that plays into it. I think China is genuinely in trouble, though, and I think that will have wider implications for economies across the globe. I think China's been struggling for a long time. I don't think we've seen the extent to which it's been struggling, because China doesn't, I mean, I shouldn't say this, but China doesn't always release the data that we expect or it should be releasing. So I think if it was more transparent, people would be more worried, and as that transparency increases, people will become more worried about what's happening.
Okay. And the Chinese authorities, they've got quite a job on their hands, haven't they? Because at the same time they're trying to reform the financial markets, but open them up to international trade, and also keep the economy on track.
Yeah, difficult, really difficult. I wouldn't want to be tasked with it. They've found themselves in a position where they've tried to ring themselves off to produce growth, whilst at the same time trying to open themselves up, and it's now put them in a position where their domestic demand isn't really enough to meet the levels that it needs to continue growing in the way that it has done. So yeah, tough task, real tough task.
Okay, but there are a few positive signs, aren't there? I mean, the currency seems to have stabilised, and the capital flight seems to be slowing. Do you think that the government's policies are maybe beginning to work?
Yeah, I'd like to see the next few rounds of capital flight data before I form a solid opinion on it. I think they are worried about what's happening in the US. I think that's what caused the yuan to devaluate. I think that's what caused the stock market crash in China not long ago. And I think that the reason that capital flight has slowed, or decreased at least, is that they don't want to exasperate what's happening in America. But they could easily return to it. Russia is doing, Japan is doing, so yeah, we could easily see China revert to taking more money out of the US. So
okay.
Yeah, we'll see.
Thank you.
It's okay.
So let's talk about the rest of the world. Global stocks have been trading at an 8-week high. That's got to be good news, right?
Yes. Yeah, if you're in the stock market, it's great news, yeah. What lies fundamentally into the growth, I'm not sure. But yeah, if you've got an exposure, good news.
Do you think traders are holding off for more information from China at the moment?
Probably. I think China has become more and more of a barometer of sort of global sentiment. It used to be the US, now it's shifting further towards China. I am, and I think probably the wider markets will echo my sentiment. And yeah, I think we know what we expect from China, and that is translating to sort of holding off from gaining too large of an exposure, because we could get a sharp decline. Okay.
And do you think that investors are perhaps sort of relying on central banks to continue with keeping interest rates low and continue with quantitative easing programs?
Yes, very much so, yes. And I think that's a terrible thing, because it's totally unsustainable. I think we're at the end of, well, I think we're definitely closer to the next recession than we are from the last. Yeah. And I think that investors at the moment are holding on to their exposures because they feel that there's still some life left in the stock market, but everybody knows that the longer term bull run is over. What's happening at the moment is I would say the last speculative jump up before. I mean, we're seeing it in biotech at the moment. Biotech collapsed pretty much. Right. And biotech is normally pretty inelastic to the wider economy because everybody needs healthcare. Regardless, it collapsed, and the research and design element of it collapsed. And I think that we'll see, as more and more data comes out, more and more capital will be pulled out of the stock market. And yeah, as soon as it starts to come out, the rest will come out, and it could be a very quick downturn.
And what about the ECB? Do you think what's the likelihood that they might increase their asset purchase program now that it looks like the Fed isn't going to raise interest rates until 2016?
There is a likelihood. I think if you'd have asked me this time last year, I would have said that was ridiculous, but seeing what's going on in the US and China, I think that there is a high likelihood. I think if anybody was to do it first, it would be the US, interestingly.
Right.
I think that they're in a position now where the Federal Reserve is there to control inflation. Now inflation is controlling the Federal Reserve. Inflation's at zero, we're looking at deflation. Without interest rates as a policy tool, the Federal Reserve is in real trouble, and we're looking like if we do get a downturn, they've got nothing to do but increase their asset purchase program. So yeah, I think it's more likely to happen in the US, and then if it does happen in the US, the same will happen in Europe. Yeah.
Okay, thank you.
Okay.
So let's run through some of the economic news that we should be looking out for this week. On Wednesday, we're going to have the release of UK labour market data for the 3 months up until the end of August. What does that mean, Samuel? What do you think we should be looking for?
So this is going to give us some insight into what's happening in the UK, the unemployment levels. I think that there's been some concern that what's happening in Europe will filter through to UK employment, and it'll be interesting to see whether it is having the derogatory effect that everybody believes it will, or whether we are insulated to some extent.
Okay. Also on Wednesday, we're going to be receiving some US retail figures. What's the significance of those?
Big significance. We will always look to retail sales, unemployment, GDP as big indicators of what the Federal Reserve is going to do. I'm not sure it will have the impact that a GDP figure would, but I think if we do get a miss especially, we could see some real downside in the US dollar. Initially, obviously, then longer term we might get some upside because it would suggest that we might see a longer term interest rate hike. But yeah, it could have a big impact in both the forex markets and the stock markets.
Okay, great. On Thursday, the US is going to be publishing its latest inflation figures, as well as some projections for interest rates and growth going forwards. What should that mean to us then, Samuel?
Inflation again will be huge. The real hot topic in the US at the moment is whether we will see deflation. That's why the Fed didn't raise rates last time. It's why we're now looking at 2016 before they potentially will. If we get deflation, it's really going to be a sign that the global economy is weakening, and it will definitely push back interest rate hikes to 2016 and suggest that we might see some QE.
Okay. We're also going to receive on Thursday, Janet Yellen will be giving a press conference. She's the chair of the US Federal Reserve. Is that going to be an interesting one for us?
Again, yeah, definitely. And I believe there's a Q&A session there, so the real interest lies in the fact that it's not going to be scripted. She's going to get asked questions that will be tough questions to answer. She obviously will, of course, be prepped for the questions, but it makes it all that more interesting because we can see lots of volatility based on her answers. Hawkish, dovish, whichever way she goes. That's what's going to make the currencies move, especially.
Okay, so we might get some real insight there.
Hopefully, I'm hoping so. Yeah. And we will get some market insight based on the currency market's response to her comments. We'll be able to then sort of judge what she or what market sentiment is based against her opinion. So yeah, another big one.
Great. Also on Thursday, Mario Draghi, the president of the ECB, will also be giving a conference. How about that? Do you think what sort of things should we be looking for in that?
Very much the same. We should be looking for. We'd like to see some hawkishness, get some euro strength. Likelihood is we'll get dovishness. Depending on what Janet Yellen has said earlier, we may see sort of the euro USD fend off against each other. If they're both dovish, it will be extremely volatile. Could get some good breakouts.
Great. On Friday, we're going to be seeing some US production data. Samuel, is that going to be important to us?
Again, yes. Industrial production has been one of the few figures out of the US over the past 6 months that's been quite strong. it's a strange one in the sense that normally when we get increased industrial production, we'll get some level of inflation. We haven't done. So if there is a decline in industrial production, it's pretty serious for the US economy. If we do get an increase or a steady level of industrial production, I don't think markets will look at it as that insightful. I think they're looking at the inflation data far more now because the wider data doesn't seem to be that representative of what's actually going on in the US economy. So yeah, a miss will be serious. A beat won't have that much of an effect, I don't expect.
Okay, great. Many thanks for joining us.
No problem. Anytime.
Thanks for watching this week's Active Trade News. We'll be back next week with further economic commentary, news and analysis. Thank you.